Hi, I'm Megan Kopka with Kopka Financial. This is Investments 101. The goals of teaching this course is to better understand investments, to better understand the market cycles, and to better understand the risk of investing in the market and the math behind calculating risk. Investing in general means that you're going to allocate your resources. Usually it is money with the expectation of generating income or profit in price appreciation. Investing is done with an expectation of benefit in the future called a return, a gain, or a loss from a sale of property, business, or investments. Simply, investing is your capital earning more capital or money making money. And the objective is to buy low and sell high. Solving what is right and best for you at this time of life comes from financial planning. So this sleeve again is just about investment management. Financial planning helps address your life phase, your health, your earning level, any benefits packages that you might have through work, company perks, along with all of the past decisions you've made for yourself, whether it's risk management and insurances that you've put in place, loans or liabilities for assets that you chose to buy that have a loan attached to them, and then also your risk tolerance. So when we get to the end of understanding this introduction to investments, I will be following up with what's called a risk tolerance questionnaire. And with that, so we begin. Investment 101. This is going to be a quick introduction of math and history. We're going to take a look at how investors make money by the numbers and also throughout time. We're going to start very basically by introducing a couple of vocabulary terms that will be helpful for you. A stock. What a stock contract is it's a form of shared ownership of a company. Firms are supposed to be innovative and they want to grow. So to do so, they need money. The firm borrows money to fund a project. Where do they get that money from? Well, this type of shared ownership means that the borrower will get the money with a promise to pay a value in the future. Instead of payments like a contract or a loan, the firm can offer shared ownership. So a firm will issue stock, which is a piece or a division of ownership in a company. Stocks can also be called shares, and shares are equal portions of a company stock. When a stock first issues their shares, it's called an initial public offering. After the initial public offering, the shares are now public and the stock may trade on the secondary market. So really, unless you're involved in an initial public offering, which means you're probably employed by the company or you're a huge institutional investor, you are likely trading on an exchange and you're buying that loan to the company from someone else. The stock exchange is an organized market where buyers and sellers come together to trade their shares. And as we like to look at the stock market, prices are always valued with the best information to help those buyers and sellers come together. We use a broker-dealer, which is an intermediary that offers places for you to buy and trade stock. Some stock is held in what's called street name. You might have share certificates for stock, but we don't see that as much any longer. You might have a computer shares account or a brokerage account at Fidelity. A brokerage account is like a bank account, but it's one that holds securities and your cash for trading. Synonyms for stock are shares and also equity. We might talk about your stock holdings as the equity portion of your portfolio. Next up, we have bonds. Bonds are, again, same thing, a company wanting to raise money, but this is a contract for payment. It's not a promise for future value of a company where you have shared ownership. This is more like a traditional loan. So a bond is a contract where you as a buyer of a bond is lending money to the firm. There are three main types of bonds. There are government bonds. The government issues bonds essentially to not raise taxes, to help with the money supply. There are corporate bonds, like you could own a Ford Motor Company bond. And there are also junk bonds. These are higher risk companies, so they're willing to pay you a higher interest rate if you're willing to take a risk on them. So those are the three main styles. In general, bonds are considered safer because if a company goes insolvent, bonds are paid back first. Also, there's a set of terms in the agreement, and that means that you're holding a bond for a certain amount of period at a certain interest rate for the price that you paid. What happens is bonds trade at something called par. Par is $1,000. Most of the time, we don't see people buying individual bonds at less than like $10,000. So again, using par, $1,000, and maybe the going interest rate is 4%. That sets the price for today's going interest rate. You're willing to lend a company $1,000 to get a 4% return for maybe the next 10 years. So what that means is that you would get $40 per year for 10 years. And at the end of 10 years, you'd get your $1,000 back. That is a contractual loan. They're just making the interest payments, but in this case, we call it a coupon payment. Back in the day when a bond was issued, you actually got strips of paper called coupons that you had to mail into the company to get that interest payment. Typically, bonds pay twice a year. So in this example of the $1,000 bond at 4%, that means you would get a $20 payment in January and maybe a $20 payment in June. Now, it could be any month. That's just an example. But you would be getting $40 a month or $40 per year over the next 10 years, and then also get your $1,000 back. The loan would be complete at that time. Synonyms for bonds are fixed income or debt instruments. I also have an asterisk down here. Notes and bills are a type of fixed income as well. Usually we have notes, bills, and bonds. Bills usually refer to fixed income or debt instruments for under 1 year, and notes usually range from 1 to 10 years. Next up, we have probably what's most familiar to you. We have funds, also called pooled investments, also called ETFs, exchange traded funds, or electronic traded funds. Mutual funds are pooled investments. And what they do is they group together under a particular strategy, a group of stocks, or maybe a group of bonds, or if it's a balanced fund, they might have a combination of stocks and bonds inside of one fund. A mutual fund might be, another example would be a large capitalization growth company. What would be a good example of a growth company is a company like Microsoft, or a company like a healthcare company, right? So pharmaceuticals are usually a good example of this. Not Johnson & Johnson, because they actually are more of a value and stable, even though they do have a pharmaceutical side. So pharmaceuticals are usually the ones that are, considered in the growth category. So if you have a mutual fund and you wanted to have growth stocks like Facebook and Microsoft and Amazon and Apple, you would find it probably more affordable to get a mutual fund than to save up money to build your own diversified portfolio. So mutual funds are considered the best starter investment, mainly because they're convenient, right? We're familiar with them because they're inside 401ks. Oftentimes people are buying funds and advised to buy funds even when they go to like a Fidelity or a Vanguard. They are affordable, right? I use the example of Amazon. So let's say you're contributing to your 401k and you're contributing $300 per month into a well-diversified portfolio. If you wanted to buy Amazon, and today is May 2nd, you would need $2,490 to be able to buy Amazon right now. If you were investing $300 a month, that's what you could afford, then you will be 9-10 months down the road before you could purchase just one share of Amazon. So that's why mutual funds are affordable. You get to name your price and you get to proportionally own part of a fund that owns a lot of stock in many, many, many different companies. Because there are so many choices inside the funds, they are also considered safe, right? We call this diversification. You don't want all of your eggs in one basket, waiting on just one company like Amazon to make it or break it. You want diversification. So again, funds are convenient. They're affordable because you name the price, and they're diversified. They are typically a large pool of packaged stocks together. There might be a large pool of particular bonds together, like maybe a corporate bond fund, and they get divided up amongst the investors. Doesn't matter what type of fund it is, you proportionately own a piece of that mutual fund. The difference between mutual funds and exchange traded funds. Mutual funds operate a little bit differently. There are people involved. We have money managers that get to select what type of stocks go into that fund. These are investments where you'll get a large booklet or a very long, lengthy PDF in your email, and that is called the prospectus. The prospectus lays out the rules of that fund. It says, hey, you have to be a large capitalization fund, or hey, you can only be a bond fund. So you expect them to play by the rules and stay in their own strategy. They also might say, this fund is allowed to have anywhere from 0.5% to 4% in cash, right? So mutual fund advisors aren't allowed to get scared and take all the money out of the market. They have to stay invested. We're not paying mutual fund fees to have money managers put us all in cash. We could do that for free at the bank. We don't need that. We need professional management. And so the prospectus makes the rules of what they're allowed to invest in, how much cash they're allowed to hold, possibly upper limits of different stock positions and things of that. Mutual funds are also a little bit different. When you go to trade stock, you can buy stock all day long at different prices, right? The market is constantly resetting. It might be only pennies at a time. It might be dollars. And there might be huge swings sometimes in one day. Whereas mutual funds trade at what's called NAV, stands for net asset value. So all those pools of stock get totaled up at the end of the day and sets a new price for the mutual fund. So mutual funds trade at net asset value, and they trade after the market closes at 4 p.m. So probably like 4:01, that price has reset. Funds also, these pooled funds have loads, they have fees. They're very different from stocks and bonds. Because mutual funds have a team of advisors, they also have marketing expenses and salaries that go along with them. They tend to be a little bit more expensive. There's a human element to the mutual fund where there is not to the exchange traded fund. An ETF follows an index and it trades electronically, however that index is held, versus the mutual fund who has people that are making those decisions. ETFs also trade just like stock. They trade all day long at various prices that are moving. This helps make them a little bit more tax efficient. And because we don't have salaries attributed to ETFs, the expense ratio is typically a lot lower. So those are your pooled funds. Those are your pooled investments, exchange traded funds and mutual funds. Next, we have a very, very busy slide. This slide is essentially a chart from 1925 all the way through 2020. What would happen if you put $1,000 into various investment vehicles over the last 95 years? So if you look to the left, here we are at 1925 with $1,000 right here, and we track it all the way here to inflation, gray. In order for your $1,000 to retain the same purchasing power in 2020, it must be worth $14,441. Okay, that is a 2.9% return. That's what inflation has been for the last 95 years on average. If you took your $1,000 and you invested in the very safe treasury bills, you would see that you would get a return of $29,357. That is a little bit better than twice inflation. Notice percentages does not work like that. This is not twice the percent. Compounding interest is exponential. It doesn't work like simple linear math. Okay, this is where Einstein comes in and says, there's nothing more powerful than compounded interest, right? And this is how you start off and have your money making money, and it grows and grows and grows. And all of a sudden, those percentages mean so much more later on down the road. Okay, so if you look right above treasury bills, there's bonds. If you invested $1,000 in 1925 through the stock market crash, through the tech bubble, financial crisis, all the things that are going on throughout the years in our world, you would have $111,411, a compounded interest rate of 5.1%. Let's jump all the way to the top. US stocks, compounding interest at about 10% over the last 95 years. If you invested your $1,000 in US stocks and you reinvested the dividends, you would have over $8 million. Right underneath that is the growth portfolio coming in at 9.2%, right? Just less than 1% less. Remember, compounding interest is happening here. And you would have a little bit less than half of what US stocks returns. So the great thing to watch down here across the bottom, let's see if I can blow this up a little bit, is you can see through the decades what the returns have been like. So right here, you've got the Vietnam War decade here from 1960 to 1970. On average, US stocks returned 7.8% for that 10-year long period. Here we have our oil crisis in the early 70s, mid 70s, and you'll see that that stock return is 5.8%. You jump into the 80s, stocks return on average 17.6%. Now let's move over to our financial crisis. From 2000 to 2010, your stock return was negative 0.7%. We had the tech bubble crisis, and then we had the financial crisis. Sorry, tech bubble burst, and then the financial crisis. This was one that people often called the lost decade. Now, US stocks is negative 0.7%. Growth was up 2.6% despite the tech bubble burst. All right, so when you look at what's going on through the decades, for the most part, you will see that the returns in the market are usually up over a 10-year time period. Now, if you change those 10 years, these numbers are going to look very, very different. But overall, you can see that the market is trending up. There is a lot of volatility, a lot of up and downs through all of the Black Mondays and the crises that we've had, the wars that we've had, the interest rate hikes, recessions, all of our world events and our life events, the market likes certainty, right? And it performs well when it knows the rules. So even you'll see spikes and downturns in political elections, bad news for certain companies if they're big ones, those types of things. Next, woo. All right, here we have the case for diversification. What we want to do is we want to spread our assets among different types of investments and the styles of investments. So we're going to look at a timeline in columns. All of these vertical columns represent a year starting on the left in 2002. In 2002, on the bottom left-hand corner in teal, you will see the worst performer was large capitalization growth stocks. They lost almost 28% in 2002. The best performer was commodities. They earned almost 26%. So you can look up and down and see where these investment classes actually fell and how well they performed. So if in 2002 you invested all of your money in large cap growth and lost almost 28%, maybe you were like, forget it, I'm done, I'm out of the market, don't know what I'm doing, and you sell out. Well, too bad, because the next year in 2003, here in the teal, you see that large cap growth returns almost 30%. Doesn't mean it's the best performer though. Best performer was actually small and mid capitalization stock companies. Okay, so what this sheet is trying to show you is that diversification works. Look through the middle at all the charcoal gray squares. We don't know the years that cash is going to be on top, like in 2008 or 2018. Better to have cash in those years than it was any other year. Now, does that mean 1.8% is the best it ever did? No. Look at 2005, 6, 7. Cash paid a lot more than 1.8%, but it's one of the lowest performers. The market actually did fairly well in those years. Then we have our financial crisis. All right, these are the years where we did see a lot of negative low returns. So you can look, large cap value in 2007 was actually down 0.17%. And then the following year in 2008, we lost almost 37%. Those are large cap value are your very large companies like Walmart and Johnson & Johnson, names that you have heard of, that you expect to be stable winners. And again, this was our financial crisis. It rocked the entire markets for a couple of years here. What they want you to see again is the diversification, and then look to the far right. You will see that there's the annualized return between 2002 and 2021. The best place to be over this 20 years was large cap growth at 10.86%. Look at how you started off in 2002, and it ends up being on the top right. Real Estate Investment Trust. We actually say this acronym as REIT. Real Estate Investment Trusts returned 10.77%. Again, despite a housing crisis, despite the financial crisis. So large cap growth with the tech bubble coming out of there, and then also real estate investment trusts after a housing crisis. Those are our top two. Coming in the middle, a much smoother and safer ride, is the diversified portfolio returning almost 8%, 7.78%. This is a handout that I often use. I call it the investment quilt. It very much looks like it could be quilted on a bedspread. On the back side, it gives some information about risk and return. So we're going to click over here. on the back, we have over the last 20 years, annualized return for stock at 9.5%. The risk that's associated with that is 14.65. We also call risk standard deviation. Now, don't get too worried here. I'm going to go through this on a very, very basic level, but standard deviation is the absolute measure of the variability of results around the average or the mean. Variability is our expected average over time. And usually we base this on history. So we look at historical returns. The average means we know returns will fluctuate, but how much should we expect them to fluctuate? So this is trying to put some numbers and some predictability together, right? We have an annualized return over the last 2 decades of 9.52%, and the standard deviation means it can fluctuate by 14.65% either way. Bonds on average over the last 2 decades have returned about 4.33%, 4.33%. And their risk number is much lower, 3.38%. So what does that risk number mean? All right. It's okay. I know this is very, very busy. I'm going to go through it slowly. Remember the bell-shaped curve. We all wanted to be a C student, right? This is our average, smack in the middle. Be an average person, have average expectations, right? Not really have grand expectations, but here we are. One standard deviation, that means one risk number out. What I've done in this slide is I took the stock return from the previous side up here at 9.52%. And the risk number, which is actually a synonym for standard deviation, at 14.65. So what this means is one standard deviation positive. I've rounded 9.52 up to 10, and I've rounded 14.65 up to 15. On average, a stock is going to return 10%, and it will swing 15% in either direction, which means 68% of the time is one standard deviation. We can expect that stock will return somewhere between -5 and +25. You with me? All right. We're going to go out a second standard deviation. Again, all we're doing is taking that -5 and -25, and we're going to say, well, second standard deviation, the risk number is still 15. This means 2 standard deviations out, you could have a 40% return, but you might have a -20% return. That's going to occur 95% of the time, right? But we can expect 68% of the time is going to be between -5 and 25. Less likely, but possible, is -20 to +40. When you go 3 standard deviations out, you're going from the 95 to just 99. So you're only adding on 2% on each side. It is possible, but it's not highly probable. Now we're looking at adding the risk number again. You could have the potential gain of a 55% return when you are willing to risk losing 35%. That is how standard deviation works, right? We've got our C students in the middle. We go out to B and D students, and then we go out to A and F. Okay. Same thing I did here on the bottom right for bonds, right? The bond estimated return was about 4.33%. So we just take an easy number, 4%. And that risk number was 3. Okay. So same thing, take the 4% and add 3, we have 7. Take the 4% and subtract 3, 1. One standard deviation for a bond means you have an expectation that 68% of the time you will have a return somewhere between 1% and 7%. 2 standard deviations, again, just add and subtract 3 again. Now you're looking at having a standard deviation of a possible loss of -2% for a potential gain of 10%. And then 3 standard deviations out is a positive 13% return or a -5% return. And that's our bell-shaped curve. That is risk management. That is standard deviation. Hopefully statistics class in high school and college was that easy as well. Here are the 4 threats to investment success. We understand prices of investments move up and down all the time. But remember, over time, think of the big charts, the decades at a time, the more time you have, the less risk you're actually taking. Okay, time sells away the risk. The second investment threat. So again, if you have a short time horizon, possibly between like 0 to 3 years, you probably do not want to be invested in the market. That sounds more like gambling than investing. The second investment risk is some issuers will go bankrupt. Some companies actually do close, right? Think of WorldCom and Enron. Those were 2 big ones in the recent history. Usually there's warning signs ahead of time for weak issuers. And also, this is why we have a well-diversified portfolio. You want a basket of stocks, not just one company stock, because then you're only as good as that company. And sometimes CEOs make bad calls or, and take the stock prices down. Or a great innovation hits and the stock prices can go soaring. But then you have that tendency to hang on to something, and you've really got to watch and not fall in love with what you own. The third is inflation. Remember when we invested $1,000 in US Treasuries and it was like a $30,000 return? We had to have that $1,000 be worth $14,400 today. Otherwise, you lost money. If you took that $1,000 in 1925 and buried it in the backyard and you dig it up, it's $1,000 today. $1,000 in 1925 went a lot further than it does today. So you need to keep a perspective on saving a whole lot more money or investing to outpace inflation. This is what we call the silent killer. People want their money safe, safe, safe at the bank, and the bank has dismal returns that are below the inflation rate. The fourth and probably greatest threat to investment success is human nature. It's our own psychology. It's our own human makeup and emotions. Warren Buffett is known for saying, be greedy when others are fearful and be fearful when others are greedy, right? Started this with, you just have to buy low and sell high. Well, it's really hard to hang in there when it's low. And so that's where the psychology and emotions go. Like, how much lower is this going to go? Like, I really don't want to watch my money go down. And so people will get out of the market when their portfolio is at its lowest. And then when they feel like dipping their toe back in the water because it's looking safe again, they end up buying high. They do the opposite of what actually makes you a successful investor. One more thing to look at here. Individual investors. There is Dalbar, who does a quantitative analysis of investment behavior. They've had the Dalbar study going on since the 1980s. And what they found, what they chose to study was to find out why individual investors underperformed the market, or by how much did they underperform the market. So you can see on this chart on the left-hand side, the average equity fund investor in 2016 had a 7.26% return. Not bad. But the S&P 500, the market, returned almost 12%. So there's a really huge disparity there. There's 4.7% difference between what the average investor received in a portfolio return versus what the market did. Same thing happens with fixed income. Even when it's safer, individual investors left to their own accord underperformed what was called the Barclay aggregate. Now it's just called the AG. This is the bond index. The bond index returned 2.65%, and an average income investor only received 1.23% return. If you look at this chart on the right, instead of taking just a 1-year snapshot, here is a 30-year snapshot from January 1st, 1992 to December 31st, 2021. They show us what inflation has been. They show us the average equity fund investor at 7.13%, and also the average S&P 500 return. All right, for those 30 years was 10.65%. Put dollars on that. If you had $100,000 in 1992, just to keep up with inflation, you need it to be worth $201,104 today. If you're the average investor and you invested that $100,000 for 30 years, you have $789,465. Not bad, I'd take it. However, if you kept pace with the market, then you would have $2,082,296. The Dow bar does this quantitative analysis to show you and to teach us all that staying in the market is the best and most appropriate way to be successful. And finally, I'll close with this. You don't have to go it alone. All right. I am a certified financial planner. I also do investment management. There are 2 studies out there. Vanguard has conducted a study called Adding Alpha. And what they found is that on average, working with an advisor gains you about 3% net return. So that includes our fee. So hopefully we're getting you closer to market returns than we are when you're left to your own accord as an individual investor. So that's a 3% net return. That means after the advisory fee. Russell Investments also does a similar study as well. I believe the last one I saw was like a 3.75% return, but I can't recall if that was net or gross. They do update this on an annual basis. And what they attribute the success to is that advisors actively rebalance your account, which means that you'll peel profits off of something like growth. If growth goes up huge, you peel the profits off and you make sure that it stays in a nice, rebalanced, diversified portfolio. If growth is going crazy and really growing, maybe it was a smaller percentage at one point and it gets out of whack. So you got to peel off the profits and smooth it around the pie again. The other thing investment advisors do is we behavioral coach, right? So for me with financial planning, very targeted on why do you want to get out of the market? Do we need this money now? We have a plan for this, right? Everything is very strategically invested for what monies do we need now? What monies do we need soon? And what monies can stay in the market and grow where we really can't sleep at night? We also customize the experience, right? So starting to learn about what our values are, what makes us comfortable and what makes us uncomfortable. And then also one of the places where I do feel like I really shine is being a tax smart investor. Okay. So if you have a brokerage account or if you're eligible for a Roth IRA, there's a lot of different ways to look at being tax smart and coupling planning with investing. And so both of those studies are available for you. I hope you've learned a lot today. There is a test. It's called a risk tolerance questionnaire, and you can't go wrong with it. So please go ahead and fill out your risk tolerance questionnaire and send it back to me. I will let you know what type of investor we can be, and then also time horizon comes in there as well. So thank you, and please do not hesitate to call me if you have any questions about this presentation. Again, I'm Megan Kopka with Kopka Financial, and I appreciate you watching.